All right. What is up? And welcome back to How to Invest in Commercial Real Estate. I was maybe a little too excited about that one.
It's so early, and here goes Braden.
Yeah, we normally film in the afternoon, so I'm hyping myself up a little bit. But it's okay. We are back for another super awesome, exciting show. And today is actually an exciting day because everyone loves closing days. We're buying a piece of land in Princeton, Texas, right next to all of our other pieces of land. Kind of interesting. This seller was a bit of a holdout. We literally bought everything around them, and then finally they have decided to sell. And we are building a 1,000 square foot Nucky's Hoagies. It is a sandwich shop founded in like 1995. But anyway, they are blowing up. So we're going to build them a pad right next to all of our other ones, which the first one, we closed Princeton, a month or two ago? Probably 4 months ago. It was probably the beginning of the summer. But our Chipotle pad is set to be delivered in the next week or so. I mean, it's almost done. Super exciting. We've already turned over our ground leases to 7 Brew and Salad & Go. So we should see them open up over the next few months. So a lot of movement going on down at our site in Princeton.
Can we get some pictures and video for investors on that, or have we already sent them that?
Yes, I have sent them out to investors, but you're right, it would look good. So we can throw them up here, a little picture of the Princeton site.
Yeah, it was in the last, some pictures were in the last newsletter that went out.
Okay.
Yeah, we just went down there. It's looking good. But anyway, that is not the show. Today, what are we talking about, Brian?
Distributions. And it's almost distribution time.
It's getting close. 2 weeks.
Yeah.
Best time of the year. It only happens 4 times.
Yeah.
All right, so what are we saying about distributions?
Well, the first thing you got to consider distributions when you're first setting up the deal, right? You've got to put it in the operating agreement, and you've got to tell the investors how it's going to work, right?
Yeah. So obviously, we're investing in commercial real estate. We're either developing or we're buying these existing deals for the cash flow they produce. So at some point, we're going to have to evaluate what we're doing with this cash. And typically for us and most people, we like to distribute that at the end of the quarter, right? So there's 4 quarters in a year. We hold all of that. And right around this time of the year, like Brian's saying, middle of September, right? Middle of the last month of the end of a quarter, we're starting to review financials. We're starting to put together our thoughts and some quantitative data on how the property is performing. We've got a future outlook on kind of what's going in the future. And then we also know that we set up this investment, so to speak, with some sort of general expectation of what the heck we're doing, right? So we need to refer to that constantly when we're doing distributions, constantly, right? Because in that operating agreement, there's the waterfall structure, which just means, hey, once you guys make the cash, what happens to it? How does it get back to me, the investor? And that's in the operating agreement. That's in the waterfall structure. So at some point, this business plan that we pitch you is going to say, hey, we expect, a 10 to 12% cash on cash paid out quarterly. So every quarter you could expect, 2 to 3% paid out to you and check like a dividend.
Exactly.
Yeah, and so then let's dive into that. So most of our deals, if they're cash flowing deals, are set up with a preferred return to the investor. So what that means is if and when the property makes money in a given quarter and we're going to go distribute it to the investor, if it's profitable and if we are distributing, we have to pay the 8 pref first. And then after that's paid, 8% preferred return on the invested capital, then we split the remaining cash flow in some percentage split with the investor. So let's say we pay an 8% preferred return, and then we're paying 60 or 70% of what's remaining to the investor, and then we're taking 30% or 40% of what's left over as our promote, it's called. So that's what we're talking about today. And so then let me ask a question. If the property makes, let's say the property makes $100,000 in a year. Let's say the equity raise was $1 million.
Yeah.
Okay, so it's overall 10%. Are we paying? Is that as easy as it is? We're going to pay that $100,000 out to the investor. So we're going to pay 80% in the pref, and we're going to take that 2% that's left over, and we're going to split that 70% to the investor and 30% to us. Is that as easy as it is?
Well,
on paper.
Yeah, on paper it's that easy. Look at your P&L and your NOI, and Hopefully it's that easy, but there's a lot of other.
But it's
factors.
not that easy.
No, it's not that easy, right? Because on paper, in a perfect world, and then your underwriting, roofs don't go bad. They're always perfect. Tenants pay you rent on time. They always renew for higher rent amounts, right? Like we're underwriting a vast scenario of things that could happen, and we're trying to boil all of that down to what we think we can pay out, right? So that's what we're putting in the business plan. That's what we're putting on the pitch deck, is what we honestly believe we can pay out based on real life.
And we might be a little different than some sponsors. We have an account that we put money in up front, right? We don't rely on this $100,000 a year to pay for things normally, right? We'd normally say, okay, we've got a reserve of this much. Hopefully we can pay out the whole $100,000 over the course of the year and everything works perfectly. But there are sponsors who kind of rely on some of the income to build up that reserve. Is that
Yep.
So
that's accurate?
So that's a great point. And the two differences there are focusing on the difference between your profit and loss statement and your balance sheet and your cash flow statement, right? A profit and loss is how much you're actually profiting by owning that business, right? And you may profit that $100,000, but at the same time, you may have a $100,000 new roof that's on your balance sheet, right? So yeah, you profited $100,000, but you had to reinvest that back into the center that year. So you actually couldn't do a distribution that year. So that's very probable.
Yeah. So, but again, to that point, if we knew that we had, let's say we bought a property and the roof was old, we would probably reserve for either repairs on that roof, knowing we were going to need to do that over the next couple of years, or we might say, hey, we know we've got to fix the entire roof, replace the entire roof, and we might reserve that whole amount.
Yeah, so I think the biggest thing here is you've got to be developing forward-looking statements and beliefs about the property based on realistic expectations, right? Like roofs age, HVAC units go bad, mechanical things of any nature need replaced, right? Your parking lot's going to need replaced. Your plants are going to die. You're going to have move-outs. You're going to have to pay somebody to get you new tenants. You're going to have to pay for that new tenant. So hopefully you were a judicious investor, and in your due diligence, you identified some of these things and said, hey, maybe it's a good idea to come to the closing table with a little bit of extra cash just in case some of this shit fails before I have the opportunity to make any money from that investment. And then it puts me having to put more money in that investment because I didn't anticipate any of these things going wrong. First of all, if you didn't anticipate anything going wrong, you're probably an idiot, right? Everything is going to go wrong. Yeah. And it just will.
Yeah, and our goal is to always try to streamline the cash flow to the investor. And so like you said, Brian, we're trying to identify everything ahead of time that we're going to have to spend in CapEx. And we also, you need an operating budget, like an amount of operating capital in the account to handle the ups and downs of a monthly financial statement. So, the rent's going to come in at all different times. The bills are going to get paid at different times. And so your cash is going to be going up and it's going to be coming down. It's going to be going up and coming down. And we don't want those types of scenarios to affect, if possible, the distributions. We would love to just send the investors exactly what we told them the property was going to make every quarter. They feel better about their investment and it's easier for us. So in order to do that, we try to raise that money ahead of time. We try to look at a 5-year window and say, okay, what are all the CapEx expenses we're going to have on this? And then, maybe we anticipate losing a couple tenants and what it's going to cost to backfill those. So we add that to the CapEx budget. And then we say, okay, this size of property, we want to maintain $50,000 of operating capital in the account at all times, or it could be $100 if it's a bigger property. And so all that's adding up to this amount of cash. And what we try to do is raise that along with the equity requirements of the deal. That way, once we own the property, if the property makes that $100,000, we can deliver that $100,000 to the investor because we're protected with our CapEx and our operating budget already. In a perfect world, that's the scenario.
Yeah. So more specifically, right? You can make that $100,000 on the balance sheet. You can have you can make that $100,000 on your profit and loss statement. You profited $100,000, but on your balance sheet, you still had the same problems, right? Your HVAC units went out. You had to do some roof maintenance, whatever it was. So you had maybe $50,000 of stuff go wrong that needed repaired. But because you thought of that, right, you had that money in cash, in savings, in your rainy day fund, whatever you want to call it, you can afford to reinvest back into the property on your balance sheet, on your cash flow statement, right? And still distribute that $100,000 profit because you actually profited that $100,000 and you were smart enough to know that something was going to require an investment to continue this cash flow. Like your money machine requires maintenance.
Yeah. So Joel, let me ask you, let's go with the perfect storm. And I'm thinking of Village South, where Precision bought that, and I invested in that a long time ago, right? The property's getting older, but now my distributions are increasing. What was your thought process on actually increasing distributions over the course of owning that property?
Above and beyond what you thought it would pay.
What you thought it would pay.
Yeah, that's a classic example of just the property doing even better than projections.
So you got better leases? Is that so? You're making
a few things happen there. First of all, just to cover, it is an older property, but we did reserve when we purchased the property for kind of roof and structure, parking, and CapEx. So that was all taken care of, and we're paying out. I think it was 12% to the investor for a long time.
Yeah.
But what happened is we got in there and started filling vacancy. And then a lot of the renewal leases, just because of the dynamics of the deal, we were able to increase the rents 30, 40, 50% on some of those leases. So the income continues to go up and above what I projected. Yeah. And so as that happens, and as long as we're protected on the CapEx and operational side, we're going to increase those distribution percentage. And I think we got all the way up to like 24% a year prorated on their money.
Because let's dive into that, right? Because it's so fascinating. And that's not because this property did anything extraordinary, right? That's you guys being judicious sponsors and saying, hey, here's this property. It's got, really under market rents. We think we could push some of these as much as 10 or 20%, but nobody's going to build a model that says, hey, I'm going to go increase everyone's rent by 20%. Yeah. Like that's probably a very aggressive assumption that you can do that. Yeah. So any good real estate investor at this point is saying, okay, I see upside here, but let's look at the downside. Maybe I can't fill all of that rent. Maybe I can't raise rent that much. Maybe I can't fill the vacancy as fast as I thought. What if I just put 3, 4, 5% income growth on my model? What would that do? Okay, that would look good. It'd give me 12, 13%. That's all you need. You've identified room for upside. And then on the tail end of that, right? When you're negotiating these leases, you have to get rent growth. You have to fill vacancies. If you only have to get 3% rent growth, you're not going to your tenant and just asking for 3%, right? Yeah. You're going and asking for whatever you can. If it's
always
10,
maximizing.
If it's 20, if it's 25, if it's 50, you could double somebody's rent if you could, right? You would. You don't just say, oh, I only need 3. Yep, 3% increase. No, of course not. So a good underwriter is underwriting market rent growth, right? They're kind of coupling that with a little bit of property specific rent growth, but at the same time you're thinking and that's what kind of pushed us out of multifamily, right? Is it was hard to go in and buy these 5 cap multifamily deals and say, yeah, I'm going to grow rent by 10% every year for the next 5 years. Yeah.
That's the only way the model works.
Yeah. You're insane. Pass. But a lot of people did it and a lot of people made a ton of money, but it's hard to predict that. So don't go in trying to make the model as good as possible and make it, I'm going to pay out 30% cash on cash. If you put this in reality on the model, half of the people would have been like, there's no way in hell, dude, pass. You're insane.
So think about that as we have to sometimes dumb down return expectations just so people will believe us and invest with us.
Yeah.
But the point I want to make for investors that's a really good one is there's not a lot of investments that you go into where you're totally satisfied with the amount that they're promising you, but that there's a real chance that it doubles. Just ask yourself about the investments that you've made and say, okay, they're promising me 10, 12%. That's higher than the market. That's higher than treasury bonds. It's higher than a lot of stuff I can invest in. And oh, by the way, there's a real likelihood that it'll be double or triple that.
You ever heard of Bitcoin?
Yeah. And so that literally is what we can offer investors. Now, with that, good news is that we have investments that will likely far exceed what we have promised the investor. And that happens all the time. We have many more of those. But we do have a few examples where the best case didn't work out. Like Village South, instead of getting 10% rent growth, we got 20, 30, 40% rent growth. Well, I'll give another example, Colonial, which there are investors probably listen to the podcast that are on that. That deal went the opposite direction. Everything that could go wrong did go wrong and is still going wrong. And so that's presented a lot of challenge for us, given that we want to pay out distributions, but we haven't in over a year. And so the reasons for that is we've actually turned over almost the entire building of tenants. During COVID, we lost most all of the tenants besides like 2 or 3. That's expensive. Not only do you lose the rent and lose the triple nets when they move out, but then it sits vacant for months. And then in order to get a new tenant in, I've got to pay leasing commissions. I've got to pay tenant improvement dollars. I have legal expenses reviewing the leases. So the costs compound.
A great example of a great looking P&L, but a horrible looking cash flow statement.
Yeah. And, this is a good asset that we paid out for a year or two, but then we hit the struggles, and we even had a lot of cash that we
went in with like $400,000 in that
deal.
deal.
Do a capital call on.
We've never had to do a capital call. We raised enough money for a worst case scenario, but the problem is when the worst case scenario happened, it drains all of the operational cash. So now the deal is essentially at more risk than it was in the beginning. And so could we pay out some of the money that we're collecting? Yeah. I mean, on paper, it's profitable. But the last thing I want to do is pay out the remaining operating cash or profitability that I have and then have more things go wrong and me have to do what's called a capital call. And so for the investors that don't know what a capital call is, it's when the investment runs out of money and it's at risk of making mortgage payments or missing paying bills. And so I have to go back to the investors and I say, I know the original investment was $1 million raised, but now I got to raise an additional $500,000. Who's with me? And there's going to be some people that are going to say, okay, I got the money. I trust that I'm not loading gold onto a sinking ship. I'm going to give Joel more money.
And then everyone else is deleted.
But there's other people that are going to say, you know what? I don't feel so good about this. Joel told me it was going to do this, and now it's not doing that. And now he needs more of my money. Like, I don't want to get more involved in one of the worst assets they have. I want to get involved in one of the better assets they have. Yeah. And so if they say no, now what you have is you've got a dilution of ownership of anybody that doesn't want to participate. So now they're going to get less by really no fault of their own. And anybody that sends in more money is going to get a bigger share of the deal because now the overall capital is $1.5 million. Okay. And that's not ideal. I don't want to do that. We have never done that.
Not ideal. That sucks.
And so that's why we raise money up front for this stuff, but it's also while sometimes we don't pay distributions.
That's exactly why we suspend distributions.
We have an obligation, a fiduciary obligation to the investor, but also to the deal, because if the deal fails, the investor's investment fails. And so bigger than next week's distribution is their capital. And our goal is always, number one, is to preserve investor capital. And so if the count is low and if there are struggles at the property, whether it be vacancy, whether it be roof, like we're having to repair the roof at Colonial for the second time, is we have to make sure we have enough money for all of that, no matter what. And so that's why we suspend distributions, because we want to build up that capital account to where the deal is safe. And as soon as we get it back operating profitably and we have enough cash that we think will sustain us, that's when we resume distributions. So that's all going through our head every single quarter with every single property, because we always want to make sure we get the investors their money, but we definitely don't want to put the deals at risk or have capital calls where we dilute investor ownership.
The biggest thing is there's always something on the horizon. It's identifying what's next on the horizon and maybe how far it is away. Because there's always something there. Like the roof is 10 years old. The HVAC units, we've gone over this list so many times now, but I'm trying to get the point in.
Tenants. How many leases do you have rolling in the next 1 or 2 years?
Exactly. There's always something. So you want to try to meet your return expectation, but you always want to acknowledge what's on the horizon and what's coming, right? And if people were just naturally good at this, they would inherently have more money. So it takes a specific person, a financially disciplined person, to be able to say, yeah, we made hundreds of thousands of dollars this year. We can't pay out anything.
Yeah, and I'll give us one example to close the show. So I've mentioned my struggles investing online with third-party sponsors before. It was a good learning experience. I thought, well, man, I'm making money for my investors. These guys are bigger. They have more experience. They're more professional. They're online raising money. Surely they're going to do a better job than I do. Mm-hmm. I'm nobody from Oklahoma. And one of the deals particularly was a hotel deal. It was kind of 2 or 3 hotels in like Colorado Springs. I'm thinking Colorado's a great market. Put a bunch of money in. The first distribution came out fine. They paid a decent amount. And then COVID hit, and the hotels kind of shut down there for a little while. And what was amazing to me is literally the very first quarter after COVID hit, they're doing a capital call.
Oh, wow.
And so they didn't have enough money for a rainy day. They paid out distributions the couple quarters before, and then all of a sudden they're out of money. And that's a terrible situation to be in. And it didn't give me confidence that they were financially astute enough to manage that investment. Now, have they lost my initial investment? No. The hotels are hanging on. They're doing fine. They're not paying a distribution right now. But it was just that they did a capital call, not just to spend distributions, but they did a capital call. Immediate means they didn't have any savings for a rainy day or even a rainy few weeks. So anyway, that's a big part of our business. And so when you guys invest with us, know that we're doing everything we can. Number one, to protect your original investment. We never want to lose money. The second thing is we want to maximize those distributions, but we want to do it in the safest way possible, that we don't put the deal at risk or risk doing a capital call that could dilute some investors' ownership and leave them with a bad taste in their mouth. So,
great point. Yep. Really quick, did you do the capital call?
When? Oh, no, I didn't do it.
Oh.
And this, for the same reason I think investors shouldn't do it when I ask for the capital call.
You better not do one.
Is that, hey, why didn't you have enough money ahead of time to deal with this problem? And what makes me think that you're going to figure this out if we just give you a little bit more money? Because I could just give them a little bit more money, and then the next quarter or two, they're like, yeah, we're out of money again. So it just didn't give me confidence. I'm not saying there's not ever a situation where you wouldn't do a capital call. We're going to try not to do it with our investors. Of course, there may be a scenario in the future that it just mandates it. But we're working really hard to not do that. And hopefully we don't.
Agree.
All right. So that's all on how do we determine distributions.
All righty, guys. Well, we will see you next week on how to invest in commercial real estate.
All right.